Morning, everyone. Uh, Glad to see the turnout today for this 2024 budget update. We will spend the next little bit here going over some of the updates from that budget. One notably big thing, and then quite a few smaller things that we will talk about as well. So just to give a little bit of a table of contents of what we will be talking about today. So first on the personal measures standpoint, we will be talking about the change to the capital gains inclusion rate. We will also be discussing adjustments to the alternative minimum tax regime. We will also talk about capital gains exemption changes. So there's an increase to the limit there, as well as discussion on a new form of trust called employee ownership trusts. We're going to talk about the proposed Canadian Entrepreneurs Incentive in terms of another way of helping founders of businesses be able to sell their company in a more tax effective way. We have some RRSP home buyers plan updates, and we'll talk about the Canada disability benefit as well. On the business measures standpoint, again, we will be talking about the change to the capital gains inclusion rate. We will also be talking about the Canada carbon rebate for small businesses, the clean electricity investment tax credit, and finally some updates to accelerated capital cost allowance and immediate expensing. So I figured we would start off our presentation with the big thing that's on everyone's mind and the elephant in the room, the capital gains inclusion rate changes, as that has a widespread impact on not just individuals, but on businesses as well. So the budget 2024 has proposed that the inclusion rate on capital gains increases from 50% to 66.67%, or 2/3 on capital gains realized on or after June 25th, 2024. What we mean by inclusion rate is the amount of the capital gain that is added to your taxable income, and with that, and then whatever that portion that's added to your taxable income is then subject to the corresponding tax brackets and rates applicable to that person or business. Now, for individuals, the government has proposed a bit of a safe harbor as a way to only target those that may have larger gains on an annual basis. So for individuals, the first $250,000 of capital gains that they realize in a year, those will still be subject to the current inclusion rate of 50%. And then anything over and above that, 250,000 will then be subject to that new 2/3 inclusion rate. In the case of corporations and trusts, this $250,000 threshold does not exist. All capital gains realized will be subject to this 2/3 inclusion rate. Just to run a couple of examples here on the impact of how this rate change can impact individuals. And then the next slide, I have the impact on the corporations and trusts. So we have our example one here where we have, let's say the individual has recognized $100,000 in capital gains during the year. Well, that's within our $250,000 threshold. As such, the capital gain is going to be subject to the 50% inclusion rate. Therefore, we will be including $50,000 as that into that person's taxable income. Now let's consider a slightly larger capital gain. Somebody who recognizes $300,000 worth of capital gains in the year. So now we have a situation where we have gone over the $250,000 threshold. So again, that first $250,000 of capital gains, that's going to be subject to the 50% inclusion rate. So from that initial 250,000, that person will be adding 125,000 to their taxable income. And then on the remaining $50,000 of the capital gain, that will be subject to the 2/3 inclusion rate. So that's roughly $33,000 to be added into taxable income. So our grand total being included as taxable income under these proposed changes is going to be roughly $158,000. Under our current rules, we would be including $150,000 as taxable income. So we have roughly an $8,000 difference here. So, I mean, in this case, it doesn't sound like a big difference because of the example here, but the larger the capital gain is within the year, kind of the larger the difference it will be in terms of what is going to be included in taxable income with the proposed rules versus what it gets included under the current rules. If we now look at corporations and trusts, we will use the same two examples of a $100,000 capital gain and $300,000 capital gain. With the first example there, so as we mentioned, corporations and trusts do not get a $250,000 threshold. They have to realize the full capital gain at the proposed 2/3 inclusion rate. So with example one, you're looking at roughly with a $100,000 capital gain, roughly $67,000 being included as taxable income, as opposed to $50,000 under the current rules. So we're looking at a difference of about $17,000 there. If we, with example two, we got the larger capital gain here of $300,000. It's the same concept as example one. The entire capital gain is going to be subject to that 2/3 inclusion rate. So therefore, under these new proposed rules, on a $300,000 capital gain, that corporation or trust is going to need to recognize $200,000 as taxable income, as opposed to $150,000 under the current rules, a $50,000 difference. So these two examples here kind of illustrate what I was just saying, how the larger the capital gain that occurs within the year, the more stark the difference is between the proposed rules versus the current rules. So who are most affected by these changes? So we have a couple of groups here. So individuals who are affluent investors that are managing substantial capital gains, persons holding and managing their investments through corporations, especially since corporations do not get that $250,000 threshold. It also impacts business owners dealing with high value asset sales, as now overall on those sales, you may not be potentially getting as much due to the higher inclusion rates, and as such, paying more taxes on selling these assets. And then also, it can also impact estate inheritances where sizable capital gains are a factor, as when a person passes away, they are deemed to have sold their assets to their estates at the fair market value for that asset on the date of that person's passing. So so for example, there, if you have like a business owner who holds shares in their business, that business has accrued significant growth throughout their lifetime. When they pass away, a capital gain is triggered upon their death, as they're deemed to sell the shares of their company to their estate. So the next thing that we want to consider here is, what opportunities do we have, and what are the potential pitfalls that we need to consider when regarding this proposed change to the inclusion rates. So in terms of planning opportunities, the most simple, probably one of the more simple options that you could do is simply realizing your capital gains before the June 25th, 2024 effective date, as those would be subject to the 50% inclusion rate. So, for example, here, if you have an investment portfolio that has accrued gains in it, possible consideration is realizing the gains in your investment portfolio and then immediately reacquiring those investments so that they have a stepped up cost basis going forward into the future. Another planning opportunity is utilizing the lifetime capital gains exemption on eligible sales. That's going to be that's going to be mostly restricted to sales of like eligible small business corporations, as well as eligible farming or fishing corporations as well. So if you have any this particular kind of investment, that's something worth exploring there. You may want to revisit estate plans to consider earlier transfers of asset ownership and growth. So as I mentioned, individuals, they're deemed to dispose of assets at their fair market value at the time of their death to their estate. So an earlier transfer of the growth of the assets, whether that's to your spouse or to your children or to your grandchildren or a combination thereof. An earlier transfer can help lower the value of your assets that you would be holding at the time of your death, and as a result, there would be smaller capital gains realized, and as such, a lower amount being subject to this higher inclusion rate. So some planning vehicles that could be used in terms of transferring that asset value, that future asset value and growth, is considering implementing a family trust. If you're operating an incorporated business, an estate freeze may be something to consider as well, where the parent shareholders exchange their shares for fixed value preferred shares, and the common shares of the company are then which would contain the growth of the business moving forward. Those could be held by the individual's spouse, children, grandchildren, like I was mentioning. Could be the family trust. Now, you do want to be careful here, as there were the changes to the income splitting rules of a few years back that we would have to consider when implementing this type of planning. But it can be done to help lower those capital gains upon death. And there's also ways to manage, being able to transfer the future growth of those assets, but you retain the control over the management of those asset management decisions. So, if you're looking to, pass on the future growth of your business or of to your children, but you don't want, maybe they're too young or not experienced enough yet in the business to be able to make effective decisions for the business, there's ways to ensure that you still get final say on how the business is ran. A couple other things to discuss. We got utilizing corporate-owned life insurance policies, which could be interesting opportunity here. So, with a life insurance policy, while the premiums you pay for the policy are typically not deductible for tax purposes, the assets within the policy are able to grow on a tax-deferred basis. So it does allow the investments in that policy to grow without needing to make an annual tax payment every year, which can help build that value even greater. And then and this is more specifically in terms of permanent life insurance policies. When the insured individual passes away, the death benefit from that policy can be paid out to the whether that's the estate or the beneficiaries of that person's estate. That can be paid out to them tax-free. So this is definitely one of the more interesting options to consider with the with the proposed inclusion rate increase. Donating publicly traded securities. This is one of the more philanthropic options here, which is something that could be done. It doesn't necessarily need to be done before June 25th. It can happen. It can happen after the effective date as well. If you donate publicly traded securities to a registered charity, any gains that were on those securities, any capital gain, is subject to a 0% inclusion rate. So essentially, the capital gain is not taxable when you're donating publicly traded securities to a registered charity. On top of that, the value of that security can be claimed for the donation tax credit purposes, or in terms of corporation, there's a deduction available for donations to registered charities. So there's that additional benefit there as well. And then one final planning opportunity that's not listed on the slides here, more so for individuals, is going forward, assuming the proposed rules stay as is, for individuals considering being conscious of your $250,000 threshold every year. So if you're looking to trigger capital gains, what you would, it would be more tax effective to realize the capital gains at that lower 50% inclusion rate that you get on your first $250,000 of capital gains every year. So if you are approaching the end of the calendar year and you are already fairly close or already at that $250,000 threshold for capital gains, it may just be worthwhile just waiting to hold off on realizing the gains on that investment until the new year, where your $250,000 threshold resets. So that's another opportunity there. Now with opportunities, we have pitfalls. And so, some of these things may just sound straightforward to do, but, there's certain things to consider. So first case, we have the prepayment of tax. So this is particularly more so for kind of that first opportunity that I mentioned above in terms of realizing capital gains before the effective date. So if your objective is to realize your capital gains and then immediately reacquire everything in your investment portfolio, then you would need to have cash from other sources in order to pay the related tax that has just been created due to realizing those capital gains. Another consideration here as well is I'm sure quite a few of you may remember the 1990s where there was previously a capital gains inclusion rate change, where they changed the rate to 75% of capital gains were included into taxable income. So that rate was in place throughout pretty much the 90s, and then eventually the rules did change so that the inclusion rate was brought back down to the 50% inclusion rate that we have at the current moment. So I mean, I'm not saying that what has happened in the past would happen again in the future. But this is something to consider on for assets that you are contemplating to keep for an extended period of time, like maybe we're talking about something that's like 10 plus years here. If you were to trigger a gain now in order to capture that 50% inclusion rate, but then 10, 15 years down the line, there's another inclusion rate change and we go back to 50%. Now you have just prepaid tax on your asset for no reason. Now, what's happened in the past does not indicate what can happen in the future. So, I mean, there's definitely some merit to mitigating for the fact that maybe this inclusion rate change is here to stay. But just something to consider. Alternative minimum taxes. This is more so in regards to individuals, and I will be talking about this a little bit more later in the presentation. Another pitfall to consider is the residential property flipping rule that came into effect January 2023. So if one of the properties that you're considering to recognize a gain on is residential real estate, then this property filtering rule has to be kept in mind, as any sales of residential real estate that occur within 365 days of acquiring the property will be deemed to be considered business income instead of a capital gain. Therefore, that would mean the entire gain would be 100% included in that person's taxable income, which is an even worse result than just recognizing the inclusion rate at 2/3. There are certain narrow exceptions to have this property flipping rule not apply, but it basically relates to circumstances that are beyond the person's control. If the intent is essentially just to flip the property for a profit, this rule is going to apply. The final pitfall that I wanted to then discuss is, we're talking about this proposed change here, and some of the comments that the Liberal government gave on how they would implement this rule. But the issue is that as of today, we don't have any drafted legislation. It makes things incredibly hard to plan when there's no rules that are written down in writing. So we can explain what the current situation is and potential ways to plan around that. But without this drafted legislation, it's hard to tell how effective these planning opportunities are. Maybe they could be more effective than we thought. They could be less effective than we thought. The way the rules end up being written can significantly impact a person's circumstances. What I will say is that there is a joint committee on taxation that's between CPA Canada and the Canadian Bar Association. They recently made a submission to the government, giving some commentary on the inclusion rate rules, and as well as gave a few recommendations on how to write the rules and how to implement them. So just to talk about a couple of the recommendations there. They've discussed delaying change to the effective date so that the effective date doesn't happen until January 1st, 2025, allowing people more time to plan their sales more effectively and in a less rushed manner. There's also been discussion about allowing taxpayers to file an election to realize a partial capital gain on their assets at the current 50% inclusion rate. That way, it's not all or nothing in terms of the capital gains on those accrued assets. Another recommendation is allowing individuals to share their $250,000 limit with private companies where the individual is a direct or indirect shareholder, to allow for some corporate tax relief in terms of this change. Allowing certain trusts, such as graduated rate estates, to also have access to the $250,000 threshold for the 50% inclusion rates. They have also recommended allowing individuals to carry forward their $250,000 threshold, any unused portion, to future years. So for example, if you were to recognize $200,000 of capital gains in a year, you would still have $50,000 of threshold left forward. Under the current discussions of this rate change, that $50,000 would get lost for the following year, and you would only have the $250,000 threshold again. But with this joint committee recommendation, they're looking at in that situation, your threshold for the following year would then be $300,000. So that could be useful for those who do not recognize capital gains every year. And then finally, they've recommended grandfathering sales of capital property that have been legally entered into before the 2024 budget date, so April 16, 2024. So that those sales are subject to the 50% inclusion rate, because with especially when you're dealing with high value assets, there could be things that delay the process and delay the closing of such sales. It's the joint committee's opinion. It would be unfair because of these delays if they were to happen then after June 25th. The asset sale would be subject to the would be subject to the 2/3 inclusion rate instead of the 50% inclusion rate. So that's I hope that provides everyone a good overview on the capital gains inclusion rate, its impact, its opportunities, and pitfalls. We will now be moving on to the additional personal tax measures. And so first of all, there's no changes to the federal tax bracket rates. The 33% top bracket begins with taxable income of over 246,000 roughly for 2024. As I was mentioning, there are going to be changes to the alternative minimum tax that are proposed to be effective for 2024. These were originally introduced in the 2023 budget. What alternative minimum tax is it is a refundable tax on individuals who where a significant portion of their income is taxed at preferential rates. So such as capital gains, they're not fully taxed. Dividends to a certain extent are not fully taxed because there's the dividend tax credit. So there's a background calculation that's done with the person's tax return to determine, okay, how much if we adjust for these preferential tax treatment effects, how much tax should this person be paying? And then while you do pay the tax, it is you can apply that tax paid as a credit against future taxes owing up to 7 years from when you first incurred that alternative minimum tax. So the current rates on alternative minimum tax, or AMT for short, is 15%. They are looking to increase this rate to 20.5%. Now, there is a base exemption on the alternative minimum on the AMT. Currently, it's $40,000. they are looking to increase this to $173,000. So this should carve out a significant number of individuals who do not make that level of income on a yearly basis. They will be exempt from the AMT. Now, if you're over that exemption, the AMT base is going to further limit tax preferences. So in the current AMT calculation, the capital gains inclusion rate's at 80% for AMT purposes. Capital gains will be included at a 100% rate. In terms of capital gains that are eligible for the capital gains exemption, 30% of those capital gains would be included for AMT purposes. If you have capital losses and ABLEs, which are allowable business investment losses, those would apply at 50% for AMT purposes. And then many deductions for AMT purposes are going to be limited to 50%, such as employment expenses, childcare expenses, moving expenses. There's a few more. The 2024 budget had some adjustments to the original proposals, which are designed to help relieve some of what they originally proposed. So first, in regards to donations, they were proposing that the donation tax credit claim would only be 50% for AMT purposes. They are now looking to increasing that to be 80%. So as a way to not punish those who make significant donations. We also have deductions for the now for the guaranteed income supplement, social assistance, and workers' compensation payments. Those would get deducted out of your AMT taxable income. So a couple of favorable changes there for individuals in terms of the AMT front. We got the lifetime capital gains exemption. Again, this is on eligible sales of small business corporations, certain farming corporations as well, and certain fishing corporations. A person who's never used their limit before currently has $1,016,000 of capital gains that they can exempt from their income. The 2024 budget is proposing to increase this limit to $1,250,000 for any sales realized on or after June 25th, 2024. And then the indexing increases to the limit based on inflation that will resume in 2026. Another topic in the 2024 budget related to the gains exemptions is the employee ownership trust. And this was originally introduced in the 2023 fall economic statements. Long story short, an employee ownership trust is a vehicle to allow business owners to more easily transfer the business to their employees as part of succession planning. And with this employee ownership trust, it's going to be completely unrelated to that business owner. There's the business owner has no involvement in the decisions made by the EOT. So if this is if this is a route that a business owner is looking to take in terms of passing on their business, eligible sales to the EOT can result in up to $10 million capital gains exemption. It's important to note that this is not per individual. Multiple sellers must share the $10 million exemption. So I guess you can say the exemption is on a per business basis, not a per person basis. There are narrow requirements restricting what is an eligible sale. So, a few of the things that I've listed here, substantially all of the corporation's assets are used principally in active business immediately before the disposition. The vendor or their spouse is actively engaged in the business for at least 24 months prior to the transfer. Again, the vendors deal at arm's length with the EOT, so there's no related persons involved in the EOT. The vendors themselves are not beneficiaries or trustees of this EOT. Finally, and then beneficiaries of the EOT must be employed in the business at the time of sale. Now, the things we got to be careful with this EOT exemption is we can have disqualifying events that can retroactively deny this exemption. So some of the things I've listed here is that the vendor must deal at arm's length with the business in EOT at all times after the disposition. The vendor cannot hold any right that reverts control of the business back to the vendor. If the EOT loses its EOT eligibility within 36 months of the sale, that's going to retroactively disqualify the exemption. And if the value of the company's assets ends up being less than 50% used principally in active business for 2 consecutive taxation years within that first 36 months following the transfer, we can have a retroactive disqualifying event as well. So a potential tax effective way to pass your business on to your employees, but as you can see, there's a lot of requirements and potential pitfalls to be wary of. Another proposed measure in the 2024 budget is the Canadian Entrepreneurs Incentive. This is proposed to apply to eligible dispositions on or after January 1st, 2025. What will happen here is individuals are going to be able to accrue a $200,000 incentive limit annually with a maximum incentive limit of $2 million. As I say here, January 1st, 2034 is the first opportunity to utilize the full $2 million incentive limit. Now, what this incentive does is if you utilize this incentive, the capital gains inclusion rate that's subject to the incentive is reduced by 50%. So, if we're using the current proposed 2/3 inclusion rate, if you were to have a sale and you utilize this entrepreneur's incentive on $2 million worth of up to $2 million worth of capital gains, your inclusion rate could be reduced to 33% instead of so 1/3 instead of 2/3. Now, there is stringent eligibility requirements that apply to this. So the individual is a founding investor or has held shares in the company for at least 5 years. The individual was actively involved in the business through the 5 years prior to the disposition. There's votes and value test for those shares. They have to represent more than 10% of the company's votes and value. And there's also asset value tests for the business that are similar to the lifetime capital gains exemption eligibility requirements. Certain businesses are disqualified from the incentive that I've listed here. So some businesses disqualified are professional corporations. You also have businesses operating primarily in finance, insurance, real estate, food and accommodation, arts, recreation, entertainment, consulting, personal care, that are disqualified, as well as corporations where the principal asset is considered to be the reputation or skill of one or more employees. So you're probably wondering to yourself, then what business does qualify for this incentive? Because it feels like I just mentioned quite a few industries here. I mean, off the top of my head, some businesses that quickly come to mind that would potentially be eligible for this incentive are those in the retail and manufacturing industries. I'm sure there's others as well, but yeah, but as you can see, it's a very there's a very narrow window of who's going to be able to claim this incentive. If you're able to use this incentive, though, you are able to use it in combination with the lifetime capital gains exemption. So you can claim your lifetime capital gains exemption on a portion of the sale, and then another portion of the sale you can utilize this entrepreneur's incentive. We have some home buyers plan updates that I'll just discuss quickly. The eligible withdrawal limit from your RRSP for the purchase of a home for first-time home buyers is proposed to increase to $60,000. It's currently $35,000 for withdrawals made on or after April 17th, 2024. Government's also proposing to delay when repayments are required. So there's a 15-year repayment period related to the home buyers plan that you have to pay it back to your RRSP, or else you recognize a taxable income inclusion. So for eligible withdrawals made between January 1st, 2022 and December 31st, 2025, they are proposing to delay when the repayments start to be 5 years. So for instance, if you made a qualifying withdrawal in 2022, under the current rules, your 15-year repayment period would start this year in 2024. But with these proposed changes, the repayments, the required repayments actually would then not start until 2027. The Canada Disability Benefit, this is the last item for the personal measures here that we're going to discuss today. This is going to be a tax-free payment to eligible Canadians beginning in July 2025. It's proposing a maximum benefit paid to $2,400 annually. To be eligible for this, a person has to be between 18 to 64 years old. They have to be a low-income person, which the government has not yet defined who a low-income person is, and they have to be approved for the disability tax credit. To get approved for the disability tax credit, there is an application form for that, the T2201, and that's going to require inputs and a signature from a medical practitioner to certify the person's medical conditions. I just have 2 more slides here. I know we're approaching 10 o'clock here. I have probably about 5 more minutes of material that we can discuss, and then we'll leave a couple of minutes of questions. I mean, as Chris mentioned, I mean, this is being recorded, so if you do have to step out at 10 a.m., we will be sending a recording of this presentation to you so that you can watch the remainder of it at a later time. So a couple things to mention with the business measures. So first, there's no changes to the corporate tax rates. I then want to just talk quickly about the Canada carbon rebate for small businesses. So this was something that was promised to businesses all the way back in 2019, I believe. Uh, uh, and it's finally rolling out now. It's going to be a refundable tax credit for corporations with less than 500 employees. The credit's going to be calculated based on the number of employees the corporation has and where those employees are. As the employees, you get credit for the employees that work within the provinces where the carbon tax is applicable. They haven't. There's no indication from the government what the what the rates are, but the government does anticipate that they will be paying out over $2.5 billion related to this program to over $600,000 to over 600,000 businesses. So they are looking to do a retroactive payment of this rebate. So in respect of the 2019-2020 through 2023-2024 years available, you will get your rebate on time as long as the corporation has filed its return for the 2023 taxation year by July 15th, 2024. So that's a deadline to keep in mind in terms of being able to get that rebate in a timely manner. We also have here the budget and talk about additional details for the clean electricity investment tax credit, which is a refundable tax credit equal to 15% of the cost of eligible property acquired by a corporation. This eligible property includes equipment that generates, stores, or transmits the electricity from solar, wind, water, geothermal, nuclear, fission, other sources of clean energy as well. In some cases, the credit could be reduced to 5%. It's related. This is dependent on meeting certain labor requirements, which are outside the scope of this presentation to discuss. And this tax credit is going to be applicable to additions available for use after April 15th, 2024, and before 2035. All right, final slide. The accelerated capital cost allowance updates. CCA, tax depreciation is another term that people like to use for this as well. It is a declining balance method way of depreciation where your unamortized value is multiplied by a certain percentage based on what asset class it belongs to, and then that's your depreciation for tax purposes for the year. Now, throughout 2021 to the end of 2023, we had as a COVID relief measure certain CCA asset classes were subject to 100% immediate expensing. So you could claim the entire cost of the property as a tax deduction in the year of acquisition. That is no longer the case. That has ended as of December 31st, 2023. We did get some new immediate expensing rules, though, for certain assets. So I've listed them here. So we have Class 44 for patents or right to use patented information. Class 46, which is data network infrastructure equipment and related software. And Class 50, which is computer equipment, general purpose electronic data processing equipment, and related software as well. Any acquisitions of any of these assets after April 15th, 2024 is going to be eligible for 100% immediate expensing as long as they are available for use before January 1st, 2027. Now, while we don't have the immediate expensing on certain CCA classes anymore, we still have the accelerated investment incentive for that applies to certain assets available for use before 2028. And what this incentive does is, in the year of acquisition, you are going to be able to claim double of what you would typically be allowed to claim as your CCA or tax depreciation for this particular year. So while while not immediate expensing, still a small benefit that's still available to acquisitions between now and 2028. Finally, we have the residential complexes. Those are typically depreciated at a 4% CCA rate. The budget is proposing situations where they could potentially be eligible for a 10% CCA rate. So in order to meet this, the complex has to have either 4 private apartment units or at minimum 10 private rooms or suites. At least 90% of these units are held for long-term rental. The construction of the complex began after April 15, 2024, and before January 1st, 2031. And the construction is completed, and the complex is available for use before January 1st, 2036. So, here, this is trying to incentivize people to create additional long-term housing options, and by providing them a additional CCA rate once those buildings have been constructed. So that brings me to the end of my presentation, and I'll refer things back to Chris for a couple comments, and I'll take a quick look at what questions have come in throughout the presentation.
Thanks so much, Mike, and thanks to everyone for sticking around. If you've ever watched the federal budget be delivered live, it's about a stack of papers about this tall. And so kudos to Mike for breaking that down to about an hour for us. Hopefully that was helpful for everyone. We do have a couple questions in the Q&A section. If you've had anything pop up, please post it there or in the comments, and we can take a look there as well. If we do run out of time before getting to your question, please either email it to your account manager at Bateman-MacKay, or if you don't have one of those, you can send it to info@Bateman-MacKay, and we can get it to the right people that way. Just a quick note about questions relating to the capital gains inclusion rate changes. Often those are very specific and have unique circumstances. So if you have a question that is sort of specifically about your own personal circumstances, I'd encourage you to reach out to, again, your account manager or members of our tax team specifically for advice on that. And with that, I think I can pass it back to Mike to go through a couple of the questions in our Q&A spot.
Great, thanks, Chris. Appreciate that. So couple questions I've come in here. So the first question that I'll address is, what impact does this new rule have on dividends earned in family trust? I'm assuming the person here is referring to the this was referring to the capital gains rate inclusion changes. So if for that, in that case, there's no impact in terms of the dividend. That there's no changes to in terms of the dividend taxation. It's applying to capital gains only. If the person was referring to a different part of that presentation, feel free to send me an email and I can re-answer that question. Another question that we got in is, so can an investor use a like-kind exchange when selling an investment, investment real estate? Capital gains can be deferred or minimized by purchasing similar investment real estate. Time limit. So there is so within the Tax Act, so I'm sticking with the context of real estate. There is rules within the Income Tax Act for acquiring a replacement property, and this is going to be related to real estate that's used in an active business for a company. If you have a situation where, like, maybe you're looking to, your business is growing and you're looking to move into a larger building as a result, you could be able to defer the capital gain when you sell your old property by reducing your cost basis of the new property that you acquire, as long as that acquisition happens, the sale of the old property and the acquisition of the new property happens within 12 months. Now, there are certain situations where that time period could be extended to 24 months. In the event that the replacement is due to involuntary purposes, so such as simple example is that a fire completely burns down your old building and you need a new one. So that's an additional time limits there. Again, this is more for real estate that's being used within a person's active business. This deferral does not work for investment real estate properties, passive rental real estate properties. But in terms of those properties, maybe something to consider there is a concept known as a vendor take-back mortgage, where you do not receive 100% of the sale proceeds right away. A portion of that, the portion of the proceeds is a mortgage that the vendor issues to the purchaser. And this could allow you to utilize the capital gains reserve on the sale of this property, which could potentially allow an up to 5-year deferral on the complete capital gain for that sale. At minimum, at bare minimum, 20% of the capital gain is going to be realized throughout each year in that 5-year period. But that's a potential deferral opportunity there. The final question I have here is in terms of an estate freeze, what is the threshold needed in order for the cost and the process to be outweighed by the benefit of taxes saved? And that's that's unfortunately a bit hard to answer, because that's going to be different for everyone's situation and what's everyone's kind of risk tolerance, and for some people, a lower threshold is going to seem beneficial to them versus versus others where they want to see a greater benefit before they utilize this kind of planning. So if again, this if you whoever asked that question, if you wanted to send me an email regarding your question, kind of to follow up about this question, I'm happy to discuss it more in terms of your own personal situation. But long answer short, it is going to depend and vary based on the kind of person and the kind of business. And that's all I got.
Okay, thanks so much, Mike, for covering everything there and addressing those questions as well. I've put Mike's email in the chat, so if you have any follow-up questions, you can get it there. Thanks again, everybody, for attending, and we hope to have another breakfast with the tax team in the early fall, so keep an eye out for that. And with that, I think we can wrap everything up. Have a great day, everybody. Thank you.
Thank you, everyone. Have a good rest of your day.